Now that it looks like Trump has all the political backing he'll need to extend the Trump tax cuts through 2033, let's discuss the single greatest mistake you'll need to watch out for when doing a Roth conversion. Now that it appears almost certain that you will likely have 9 years, including 2025, within which to take advantage of historically low tax rates, it's critically important that you don't succumb to Roth conversion over-exuberance along the way. You want to convert your money slowly enough that you don't rise into a tax bracket that gives you heartburn, but quickly enough that you get all the heavy lifting done before tax rates go up for good in 2034. It's all about stretching your tax obligation out over the full 9 years so you can stay in as low a tax bracket as you possibly can along the way. Given that 9-year window of Roth conversion freedom, your first step should be to evaluate the tax bracket you should avoid bumping into when executing your strategy. If you're in the 10 or 12% bracket, that's a relatively easy task. You generally won't want to bump from the 12% bracket into the 22% bracket. Why? Because in an effort to avoid higher taxes down the road, you basically doubled your tax rate in the short term. Not a very mathematically viable approach if you ask me. But most of the people watching this channel aren't in the 12% bracket. They're in the 22% bracket. For example's sake, let's say that you have $100,000 of taxable income. That puts you squarely in the 22% bracket. And given that the 22% bracket ends at $206,700, that would allow you to convert $106,700 without bumping into the next highest bracket. But given the way tax brackets are laid out, should you confine your Roth conversion to the 22% bracket, or is there more opportunity at play? Well, if 22% is a good deal of historic proportions, and I can assure you it really, really is, then you should be equally enamored of the 24% tax bracket. Why? Because for only 2% more on the margin, you can convert all the way up to $394,600. That's an additional $187,900 you can convert for a measly 2% more in tax. I've often talked about the 24% bracket being the sweet spot in the Trump tax cuts. If you have several million dollars in your IRA or 401k, the 24% tax bracket becomes the single most important feature in the Trump tax cuts. Consider this. Let's assume, for example's sake, that your taxable income from your employment and other sources continues at $100,000 for the next 9 years. We'll avoid any inflation considerations for the time being. That means you'll be able to convert $294,600 per year over the next 9 years. That means you could convert over $2.6 million to Roth and stay in the insanely low 24% bracket. How low is 24%? Consider this. It's still lower than the future version of the 22, which is 25. It's historically low. You can use it to catapult most, if not all, of your IRA to tax-free before taxes are slated to go up for good in 2034. By the way, how high will taxes go in 2034? Well, the national debt is projected to be nearly $60 trillion at that point. Our country may have no choice but to dramatically increase tax rates to avoid defaulting on that debt. Okay, now that we've identified the obvious sweet spot in the Trump tax cuts, let's talk about the single greatest mistake I see investors make time and time again. In their overexuberance for getting their Roth conversion executed just as quickly as they possibly can, they bump up into the 32% bracket or higher. Particularly now that it looks like Trump's tax cuts are set to renew for another 8 years, there's absolutely no mathematical justification for doing so. Again, you want to stretch your tax obligation out over as many years as possible while staying in as low a tax bracket as you can. So if you're in the 10% or 12% bracket, don't go higher than 12. If you're in the 22 or 24, don't go higher than 24. It's just as easy as that. Now, if you have $10 million or more and you think that an increase in tax rates in 2034 and beyond will unfairly target people with huge balances in their IRAs and 401ks, then you might be able to justify bumping into the 32% bracket or higher in the here and now, but I can't imagine that's too many of you. So again, my 24% rule of thumb on Roth conversions is most likely the rule that will apply to you. Now, one last thing. Just because you think that taxes down the road are likely to be higher than they are today, doesn't mean you should reflexively convert 100% of your IRA or 401k to Roth. Remember, you will still have a standard deduction in retirement. If you retire today as a married couple, your standard deduction would be $30,000. That means you could realize income from any number of sources. including your IRA or 401k, up to $30,000 without paying any tax at all. So the key here is to keep your tax-deferred balances low enough that your required minimum distribution at age 73 is equal to or less than your standard deduction. In a perfect world, you'd also like it to be low enough that it doesn't cause Social Security taxation. For most married couples, the ideal amount is about $350,000, and for single filers, it's about half that amount. In summary, taxes are likely to stay at historically low levels through 2033, which is the tax sale of a lifetime for those of you who are planning out your Roth conversion strategy. Just remember that the real sweet spot in the Trump tax cuts is the 24% bracket. Most of you will be able to get most of your heavy lifting done by 2034 without having to rise into the 30% bracket or beyond. Doing so could cause you to pay a tax that you didn't really have to pay, which could cause you to run out of money sooner than you otherwise would have had to. Remember, the name of the game is to adopt the retirement planning approach that will increase the likelihood that your money lasts as long as you do. I'm David McKnight. Thanks for watching.